I want to talk a bit today about the subject of stagflation. The concerns are global, that we're moving into a period, possibly moving into a period of stagflation. Now, what is stagflation? It's a period when you get economic stagnation, weak economic growth with higher inflation. Now, simplistically, one would think that that shouldn't take place. A weak economy, you would think, would be a period of low inflation. Weak demand in an economy, oversupplies in production capacity, that you would think would lead to a period of low inflation. But you can get a period of low economic growth when you've got supply side constraints, not necessarily weak demand, well, not strong demand, but it's not the demand side only, but when the supply side becomes constrained or the production side of the economy. And that has happened over the past 2 years or so. Lockdown measures, quite draconian across the world, disrupted people's lives, but also disrupted production in the economy quite severely, and the GDP drops in many economies across the world are there to show and to prove it. This led to all sorts of supply chain disruptions all over the place and supply constraints. And there's been shortages of all sorts of reported goods. The one that I noticed the most was a shortage of bicycles over the past 2 years at my favorite bicycle shop. Fancy that. The problem, so we've moved already into a period of higher inflation. The US economy experiencing some of the highest inflation in many, many years. And this is a concern for central bankers across the world. In South Africa, we're not at high inflation by our standards yet, but we have moved up. Not even a year ago, CPI inflation was as low as 2% in 1 month, and now it's at 5.7%. And there's big concern about the way petrol prices have increased as global oil prices have gone up. And there's more concern now about food prices escalating rapidly as a result of potential food supply disruptions as a result of the big Ukraine conflict. It's not only about supply disruptions that's the concern because of COVID-19, but yes, there's the direct constraints of the Ukraine conflict or invasion. And then, of course, there's the responses to Russia in the terms of boycotts and sanctions. How much does that disrupt global supply chains? So this is the talk of the town at the moment. And inflation has already risen quite significantly in many parts of the world, including South Africa, and central banks have started to act. Our own central bank hiking interest rates to date by 325 basis points tranches. What are the central banks concerned about? Many would say, well, they can't control food prices. These are really market driven and not interest rate sensitive. They can't control oil and petrol prices either, and that's true. But the problem is petrol and foods serve as certain inputs into the supply chain, into certain other sectors, food manufacturing, or petrol for many things, transport related. And the fear is that you get the second round effects because as producers are faced with higher input costs, so they try to pass them on down the chain. And that leads to a broader general inflation developing. So if central banks can hike interest rates and curb general or final demand in the economy, it can restrict supplier pricing power and how much of the cost, their input cost increases they can pass on, and thereby dampen inflationary pressures. So that's the one concern. The other concern of central banks, if they don't manage to get that right, is that inflation expectations become anchored at a higher level. We look in the rearview mirror. We see what inflation was in the recent past. Wage negotiations are based often on that. Increases in various products or price increases, annual increases, monthly increases, whatever it might be, are based often on recent inflation. Often contracts for increase that have escalations clauses in are linked to CPI inflation. So if inflation is elevated for too long, you can get to a situation where we generally expect inflation expectations are lifted. We all see it in the rearview mirror. We plan for it in the future. We escalate our prices. And that leads to a self-fulfilling prophecy because that just sustains this higher rate of inflation. And that's what central banks would also be trying now to avoid and are extremely concerned about. You get inflation expectations over the longer run anchored at a higher level, and you've possibly got stagflation, weak economic growth where we have been over the past decade or so, and higher levels of inflation. The last time that South Africa experienced this was in the 1980s. Stagnating economic growth as boycotts and sanctions, politically related or related to our political system, cut us off. We lacked investment in the supply side of the economy. So we had this weak economic growth, erratic economic growth in the 1980s, and double-digit inflation, CPI at one stage peaking at near 20%. So it can happen. It has happened in the past. We've shown it to happen, and it could conceivably happen again. It's not only about global supply chain disruptions. Locally, we've got a very weak rate of economic infrastructure investment, of gross fixed investment in general. So we're not really investing heavily in South Africa in the supply side. Supply disruptions, supply constraints, supply limitations can, in times of low interest rates and strong final demand, can contribute to stagflation. So it's not just about the global economy. That doesn't help our cause, but it's about what we do locally too. And that's what the central bank would be concerned about at the moment. Now, this has direct and indirect implications for property. The direct implications: should CPI inflation start to surge, and should food prices in particular start to surge as a result of the Ukraine conflict, and food CPI is direct. That's retail. That's a portion of retail prices going up. Possibly doesn't dampen demand for basic foodstuffs as much as it might dampen demand for non-essential items. When basic foodstuff prices rise sharply, if they do, it takes a bite out of disposable income. People need to eat, so those foodstuffs are often price inelastic. The demand is price inelastic. But they need to then start making various changes to their spending basket and would cut back on non-essential items. So I think non-essential luxury foodstuffs and non-essential retail items are still more at risk of any inflation surge, even if it is a food price inflation surge, than what food demand would be. So there's a direct cost impact for retail prices and for retail demand. There's the indirect impact on property through possible necessitation of rising interest rates. Now, we've already been hiking interest rates, and just the short-run inflation surge, we believe, necessitates more rate hiking in the near term. That's already property negative. But when you go into a period of stagflation, should we go into a period of stagflation, that would necessitate possibly a move over the longer run to significantly higher rates of inflation, such as what was the case in the late 1970s and the early 1980s. Short-term interest rates had to rise because inflationary pressures were ticking up, and of course economic growth was stagnating. Now that took with it, long bond yields rose, government finances were deteriorating too. And this all led to a rise in property capitalization rates, quite a significant upward adjustment in property capitalization rates, and quite a significant downward adjustment in real property values. We've been seeing gradual rise in property cap rates this time around again with this economic stagnation, which has put pressure on government finance and increased the level of government debt issues. So long bond yields have already been ticking up for a few years. Short-term rates have kept very low with still low inflation. But should that change, I would believe that would be a further source of pressure on long bond yields and a further source of pressure on property capitalization rates over and above the deterioration in government finances that has already been taking place. So were we to go into a period of stagflation, I would believe we would have significantly higher capitalization rates in the coming years and significantly lower real property values. How far are we into the real property value correction already? According to MSCI data, when I adjust with GDP inflation, about 25% since 2015, 2016 on. So we've already been correcting, but a period of stagflation, I believe, would probably increase or the magnitude of that property correction. So there are implications for property of such a move to stagflation too. It's not a fait accompli that stagflation is going to happen yet. It's not a fait accompli that central banks have lost control of inflationary pressures yet. But it is a key concern in the world at the moment. It was just really about COVID-19 disruptions. It's now been broadened, the sources, the causes for concern, to the Ukraine conflict and the supply disruptions that can cause, the Russia sanctions responses, which can cause more supply disruptions, and possibly even a longer run re-emergence of another Cold War II, some are calling it, where we start to rearrange the whole global supply chain more significantly as various trade boycotts and embargoes with certain countries start to kick in, should they, and global free trade takes something of a step backwards. That's the key concern at the moment.